Good evening, everyone. You've tuned into Money Control, and this is Markets Weekly. I'm Karunya Rao. Joining me today is Prateek Pant from White Oak Capital. Prateek, thank you so much for taking time out. It's
Thanks
been a
for
very,
having me
very
there.
eventful week. Very eventful week. There's LIC IPO. There was the surprise rate hike by the RBI. Fed Reserve meeting, interest hike happened there as well. Massive market volatility. Developed markets have really tumbled. Last night we saw what happened on Wall Street. There was a massive and a very severe reaction coming into Bank of England commentary and the cautiousness that they have flagged off. Prateek, what are you making of the market events? I mean, how would you describe the week gone by?
Absolutely. Thank God it's Friday. We did have, so we did have a very eventful week. The thing is, Karunya, some of this is in the making, right? We knew that there is going to be a hike cycle, which will start, with Fed tightening. I guess what spooked the market a little bit was the type of commentary which was coming out, that it could be it should have been a 75 basis, but then we are, tapering down right now over a period of time and see how this will play out. As you rightly said, the Bank of England commentary. So some of these factors, the markets always get spooked when things go beyond what the expectation is, right? And so the type of hawkish tones which are coming in right now is really what spooked the market. And when you are at slightly elevated levels, the companies or the industries which have done well in the up market cycle always get impacted in the down market cycles. I mean, as the corrections start playing in. Similarly, it's exactly what happened in India, right? I don't think you were expecting a mid-course rate hike, and while it was, last time the commentary did change, right? The guidance which was there did point to the fact that there will be rate hikes over the next few months. But the fact that you had to do a thing right in the middle of a big IPO is something which did spook a lot of people, right? And I guess, when you have this whole supply side driven inflation factors coming out, everybody is grappling with how do you deal with this, and in a way, you would take some of these steps preemptively rather than wait for things to really go bad. So I guess that's really what's happening right now, I would say, Corona.
Agree. Yeah, please go on.
No, sure. I mean, I just said these are some of the things which are happening at this point of time.
So tell me one thing. What is the most recurring question that you've heard this week from client side or from your friends and family around you? I mean, everybody, whether institutional or retail investors, everybody is quite spooked.
So we're meeting a lot of investors. As I told you, I'm traveling right now. I was in Bangalore yesterday. I'm in Guwahati today. We're meeting a lot of investors. We are actually trying to address many of these queries at this point of time. The factor is how bad can it really go? Are we going to see a serious dip the way what we had seen is 2020 repeating back in 2022, right? We've just completing a 2-year cycle of what had happened at that point of time. So some of those queries do come up. We know that we are in a situation where there was a fair bit of priming which had been done by central banks. So there was that liquidity which is there. What would it mean when you start withdrawing that? The good part really is, and while we can keep talking about the negatives, I think the good part, if you see some of the earnings numbers which have come up, even in the small and mid cap companies, have been fairly positive, right? I mean, it's not that there is a lot which is negative in the type of earnings story which is coming out. When you look at the consumption patterns which are being seen, they seem to be still intact, right? It's more the challenges are more on supply side rather than demand side at this point of time. And relatively, India seems to be doing much better than definitely the EM block, but even the DM at this point of time. So there are those silver linings which you're seeing in otherwise a little bit of cloud which is gathering around.
That's true. I mean, a lot of market watchers who we've been speaking to as well said that India is relatively looking better. But will that continue? Because typically what happens in developed markets or bigger economies, we sooner or later follow suit, whether it's in a positive way or whether in a negative way. So should Indian investors right now be concerned, the retail investor who has parked his hard-earned money in the equity markets, should he be worried about taking it out before things perhaps get worse?
Sure. So I'll talk about it in two parts, right? The first part of it is, I don't think we can be isolated if things really start uh, going bad in the US markets or European markets, right? For people to be, they will be naive to believe that India will not get impacted if there are some deep corrections which happen in the developed market. I'm not saying that it's going to happen, but the reality is that you rightly said, with a lag effect, or even at times simultaneously, you do see price corrections happening. There are various factors where, while there are some broader macroeconomic factors in the short run which determine these events, there are also liquidity factors which are equally important, because the flow of money does find its way
Hmm.
in different asset classes depending on how people see what is attractive at that point of time. Now, second aspect really around timing this is a very tough one, right? I mean, we've at White Oak, actually we've been completely on the other side, where we don't believe in taking any top down bets, whether it is looking at macro events or even looking at sectors at times. You always believe that there are opportunities which are there at every juncture, right? What does happen is you need to have a very balanced approach in
Hmm.
this. Like, if you see in the last couple of months, people had just moved away thinking that IT and consumption and some of these companies are not really that great and the cycle is over. And let's move towards cyclicals or, SOE, state-owned enterprises, public sectors. Now you're seeing some sort of price correction happening in that area. So rather than taking extreme views around this, all the important thing always for investors is to have a very balanced approach to it, right? And the way you strike this balance is that if you find you're moving away from your asset allocation, some of those reviews which happen in, let's say, a 3 month 6 month, at times can happen on a monthly basis, right? And
Yeah.
one tends to do that same asset allocation, which defines what your growth is. Because see, broadly, your Sensex has delivered about 12% return over long cycle. Your
Hmm.
corporate earnings have been around 12% over long cycles. Your nominal growth, your nominal GDP has been about 12%. So that's the nominal numbers, right, over long cycles which are there. But if there are traders who are taking trading call, that's a very different ball game. I'm not talking to that constituency at this point of time. But for long term investors, I think it makes sense to stay there, have a more balanced approach on portfolios. If you've suddenly gone very thematic in approach, believing that this sector is going to do well or that sector, that those are calls which one may have
Hmm.
to relook at, rather than taking a call on the market. We know, right? Just 2 years back, when we thought it's the end of the world and there was so much of uncertainty,
Yeah.
the markets spooked everyone on the other side, and then it became very difficult for a lot of people to come in. So somehow in these type of events, at least spending more than 2 decades in market, what I've learned is history teaches you what you have to do in the future, and you need to learn from what happened in the past.
Yeah. Agree. I hope our viewers will also take note of that. But is it time yet to perhaps, to buy the dip, as they all say? Because we've been listening to this phrase for many months now. Every time there was some volatility or some sell-off in the market, experts would come and say it's a good opportunity. A lot of these, interesting, valuable, strong businesses are available at good opportunities, at good levels rather. So is this a good time or a good dip enough to buy this opportunity, or should one still wait and see how it pans out? Because inflation, at least for the next few months, is here to stay, according to, from what we gather from various
Absolutely.
central banks and experts and economists.
So again, I guess what's going to happen in a dip like this is that you've suddenly started seeing certain sectors become quite attractive again, right? You've seen, for example, in the last few months, there was a lot of price correction in the whole IT space, in the technology companies. Uh, we've always believed, probably you have the best buying opportunities at any point of time within the tech sector, because of the inherent nature of the sector, the quality of companies which you get across market capitalization out there. And if you've seen severe price correction there, or if you've seen price correction in some of the frontline financials, the balance sheets of banks have
Hmm.
looked much better. Some of the asset management, insurance companies, and many of these companies are now actually even quoting at almost 2-year, 3-year lows, right? So in good quality companies, if you believe that the value equation is turning favorable, then it would always be a good time to try and accumulate that. I think the other interesting opportunity which will come is really back on the fixed income side, right? Somehow it was completely out of favor for the last few years because rates had just has fallen that it was it was even difficult to get a AAA bond at 4-5%, and they were quoting lower than that. I think there will be a
Hmm.
time very soon where the long end of the curve will start looking a little bit more attractive, right? So rather than playing credit, it'll again be opportunity on duration. I'm not saying it's immediate, but when you're asking me, is it time to start looking at some of these things? I'd say watch the space closely, and there could be some interesting, opportunities which may come there.
What space are you watching closely right now? What kind of themes or what kind of businesses do you guys like right now?
Sure. So we've always liked strong companies with great governance models which have solid cash flows, which are easily seen in the future, right? Businesses which are not you know thematic or short term in terms of orientation, but are sustainable and scalable in the future. And I think
Hmm.
there are opportunities, as I said, which the space which we are fairly positive right now in the whole tech ecosystem, including some of the new
Okay.
age companies, right? They've suddenly gone out of favor, but you will find
Yeah.
you will find definitely a few of them come back quite strongly during these type of periods. So I
Actually,
guess
it's
that's
very interesting you say that. Hmm.
yeah. So again, don't well, it may be, again, people may try and put everything into one common saying that these are all new age companies, but within them there are jewels, right? There are companies which are generating great cash, super cash, have solid business models which are which are going to disrupt industries going forward. But as it happens everywhere, right? Some of them, everybody's trying to discover price right now, and
Hmm.
I guess at some juncture when they start looking very attractive, that's where you will find opportunities there.
Right. In fact, I was just thinking that because many market experts we spoke to in the last 6 months, most of them have not liked these new age consumer tech companies, especially when it comes to valuations. And look at the way they have really come down crashing. Whether it's the likes of Zomato, we all saw what happened with Paytm, but even profitable businesses like a Nykaa have corrected a fair bit. So are you liking them at the current levels? Are these attractive, perhaps entry points to buy some of these names that people missed out on during the IPO frenzy or for whatever other reason?
Yeah. So I'll take a step back, right? And I'll say, see, today's many of these companies, when you put them together, are somewhere around 1 to 2% of the market cap numbers, right? Now, if you go back in
Hmm.
time and look at how China or US or some of these markets have come, in China now the new age companies are almost 25 to 30% of the market cap, which used to be about 1 2%, 10 years back. Now, I'm not saying the companies today are the companies which are going to be there in 10 years, but I think people who say that they're going to be completely out of the space are going to lose out on the next blue chip companies. So you cannot stay away from the space, otherwise your portfolios are going to get disrupted, right? Let's put it that way, because
Hmm.
a lot of innovation, a lot of the future businesses are being born today, right? And the shelf life of them, from being almost a startup to an IPO to really becoming a top-notch company, that shelf that whole journey happens in less than 10 years, right? Which used to take few decades earlier. So are we finding some of these companies
Right.
attractive right now? Selectively, yes, we are, and we've also upped our allocation into a few of those companies. Now, you cannot always take a 6-month or a 1-year view when you invest into many of these companies, because you will find the whole cycle play out over a period of time. And some of the changes which are happening broadly around will cause massive disruption, and the companies will see significant uptake. It will not happen to every one of them, and that's why I said one will have to be very discerning in terms of the type of matrix which you use to evaluate these businesses. And we've developed a model, proprietary model, where we are looking at them very, very closely right now. Also,
Okay.
one interesting
All
point
right.
is, sorry, just one final point on this. If you
Sure,
look at
sure,
the
please.
space within the private space, within this new age ecosystem, while again there have been the deal numbers may have fallen off, but there's not been a very large price correction out there. It's again, people have turned a lot more discerning in looking at businesses within the private ecosystem. But
Yeah.
you are still seeing funding available for good companies and good ideas, and the private ecosystem will finally come into the public ecosystem. You're seeing that today, right? You're seeing a few new
Right.
IPOs which are coming in the next 3 to 6 months again.
Oh yes, lots of them lined up. But let's talk about the LIC IPO. And since you're meeting investors, traveling to different parts of the country, uh, what is the sentiment, or what's the sense you're picking up? How is it likely to be? And do you guys also like LIC as a public, or as it goes to the market? Are you guys also subscribing to it or planning to?
So I can't comment as a portfolio manager on individual equity positions, but I can tell you that we're relieved that it's gone through finally, because it was important for for I mean, it was an important part of the government divestment program.
Yeah.
Finally, LIC is a flag bearer in the insurance industry, and the insurance industry has some outstanding prospects going forward. We only touch the tip of the iceberg in terms of the listings which we have seen right now, the companies which are there. So overall, we're very positive on the
Yeah.
space, but unfortunately, we can't comment on an individual stock on out here.
We were just curious because so much has gone wrong this week with the markets. We were wondering how the market sentiment has been impacted or not for LIC. But a very pertinent question, which one of our viewers is also asking us live on the show, and which I also wanted to ask, is that not only is it the equity markets, but even a gold, a crude oil, commodities like these have also corrected a tad. Metals are also finally witnessing some downside. There is cryptocurrencies as well. Of course, I'm not sure how you feel about cryptos at this juncture, but is it a good time for people to look at their portfolios, restructure their portfolio, churn if they want to, if they feel like they want to add something? Is it a good time to perhaps diversify better or plan better your investments for future?
So I guess, as I said, right, what does happen over the last 3-4 months, suddenly the balance of the market had moved towards cyclicals completely, right? And when you are going to have tightening, people will book out of sectors or companies where they've made money, right? Especially when you look at the institutional investor, which is there. And that's where, if there has been a sharp run up in any asset class, it does tend to get impacted when you're going to have uh, a interest rate cycle which is going to be around tightening or withdrawal of liquidity. So it is to be understood that in the short run you will find this. And again, I would reiterate the point that it always makes sense to have a balanced portfolio, right? Rather than trying to be uh, you know it's very difficult. It's actually impossible to time the market, Karunya.
Yeah.
And it's impossible to time even your sectoral allocations which are there. So if you have a little bit of a balance in the approach, right, across asset classes, across sectors, you're looking at flexi, a multi-cap or a flexi cap type of a strategy, um, you know to invest also across market capitalizations, then you will tend to do better in these type of volatile markets. So you may
Right.
not be a hero one day and score a 6 out of the market, out of the this thing, but at least you'll be consistently scoring those runs over a period of time.
What would be a good, composition right now, according to you, to have a good balanced portfolio that we call? What is an ideal portfolio look like for you?
So again, all these are very, very dependent on an investor appetite, right? It is also what
Yeah.
stage of life cycle is somebody at. But the way we've, let's say, constructed uh, a flexi cap strategy is that we tend to be about 55-60% in large cap, about 25 odd percent within mid cap, about 15% in 10 to 15% in small cap. The reason why we are actually significantly overweight on mid and small cap at all points, and it's not just today, is that the funnel of opportunity within the small and mid cap is very large, right? There tends to be a lot more information asymmetry out there. The coverage which a lot of the analysts do is not very complete out there. So if you are a strong stock picker and has ability to do primary research, there are those funnel of opportunities which you tend to get within the small and mid cap universe, and that's why we tend to be overweight compared to a benchmark within the small and mid cap side. But otherwise, as I said, even on the fixed income side, where people were having typically a corporate accrual portfolio, I think it'll be good to start looking at certain duration strategies and allocate out there. And I think GSEC fund managers will have a lot more to talk in the next few months. They've been out of the they've been in
Absolutely.
hibernation for a long time, but I guess this is a time when they will have
Yeah.
things to talk. So within each asset class, also you are going to see that type of reallocation, if one may say, happen in the next couple of months.
Yeah, and lots of things are happening, lots of uncertainty, which also gives birth to a lot of opportunities, like you said. So let's see how things pan out. But for now, this is what it is. Thank you so much, Prateek, once again, for taking time out and sharing your insights and your views with us and our audiences. Thank you. Great chatting with you.
Thank you, Karan. Thanks a lot.